Today, the Reserve Governor and the board met and they've kept interest rates on hold for another month. Now, it's been an interesting month, this past month. We saw the Labor Party come out with a negative gearing policy change. What's interesting about this negative gearing policy change is the way in which they've decided to treat new and existing property. Now, I'm not going to spend a lot of time talking about it in this video, but if you want further information about it, Bryce has done a great video on our newsletter in our how-to sessions, and we've also done a lot on this in terms of unpacking what we think the consequences are in our Property Couch podcast. So you can visit thepropertycouch.com.au. It's episode 51, where we really unpack what we think are the negative elements of such a policy change. Back to the RBA and the cash rate. Even though we haven't seen a cash rate movement from the RBA for some time, what we have seen is the banks moving their rates. Now, they're arguing Basel III and all these types of things, cost of funding, secured, financial system. But the reality is we're not paying the same sort of cheap interest rates that we were paying around 6 to 12 months ago. And I did tip that in the previous RBA announcement video that I did. So we've seen those movements occur. Now, that does give the RBA some capacity to drop the cash rate below 2%. If we see that further sort of increment movements or what I call margin gathers or margin gains from our banks. So just be mindful, it is giving the RBA capacity to move. So what's going to make them want to move lower? Well, of course, it's all about GDP. It's about getting the economy moving and filling up that spare capacity we have in our employment side. And what's interesting about that is that the unemployment rate is actually holding pretty well. So right now, I think the governor and the board are saying we're pretty happy where things are. And I don't disagree with them. So I don't see a rate movement down anytime this year. Now, there's always a caveat to that because that's current economic activity, what we're seeing. Now, we have seen some data come out around forward capex expenditure and forecasts, and they're a little bit softer. So that would be a concern that if we do see business slowing in regards to capex expenditure, what that will have in terms of economic activity. The other thing that's also a worry for me is the equity markets. They've been very choppy. In fact, we've seen 20% drops in the equity market in the last 12 months. Now, when you see those types of drops, that changes consumer confidence. Okay, and if we see housing prices come down as well, all of a sudden consumer confidence and consumer sentiment, because when people feel happy about their value and their wealth, they'll go out and spend, and that's what we need. We basically need to spend our way out of this sort of economic change as we move again away from the mining boom and into the more general economy activity. So it's important to understand this position. If we see a slowdown in economic activity, well, the RBA has the lever to pull to drop the cash rate lower and play around with monetary policy. If they don't see a need for that, we'll probably stay again at that 2% level. The other thing I want to talk about is China. Okay, so China is an interesting one in the sense that the economic activity and the growth that's happening in China is actually slowing down significantly. So that type of impact will have a flow-on effect to the Australian economy. They're our largest trading partner, and at the end of the day, some of our economic prosperity over the last decade has certainly been on the back of China. So it's really important to understand what happens in China. We need to watch that not only for our equities, but also for our general market in terms of what's going to happen for GDP. On the flip side of it, the US seems to be still ploughing ahead with some better economic numbers, which is a positive sign for the global outlook. I mean, the US economy is a significant player in terms of world economic activity. So to see positive signs continuing out of the US is actually a good thing. All in all, the last thing I wanted to talk about was how the housing's turned this calendar year. So we've seen some of the auction clearance rates come in for Melbourne and Sydney very high, around that sort of late 70s mark. And that's quite interesting because that would normally say that there will be price growth in those types of results when you see auction clearance rates doing that type of thing. So that said, it is on smaller volumes than we usually expect this time of the year, especially in Sydney. So a lot of people are sort of, I suppose, waiting and seeing, but what it does mean is there are still a lot of buyers out in the Sydney and Melbourne market. So I don't expect to see the numbers for the first quarter of value growth coming in negative. In fact, I see them coming in positive. Now that could be a little bit of a worry for the RBA, again, conscious about asset bubbles, making sure that the economy is moving sensibly and we're not getting this sort of bubble effect in the asset market, especially in residential housing. So let's wait and see what happens over the course of the March results in regards to auction clearance rates and general economic and housing activity, and then we'll call next month's video when we see it. Thanks for watching.